Hey there, everyone. Happy Thursday. Welcome to Chart This with Dave Keller. It's Thursday, February 5th. Welcome to the show from a snowy and cold Boston, Massachusetts. Hope you guys are all doing well. We're going to talk about a risk-off day for the major averages with the S&P 500 and the NASDAQ 100 finishing near the lows of the day. We'll talk about how the S&P 500 settling into that kind of neutral yellow light portion of the daily chart of the S&P. We're going to address the fact that the Hindenburg Omen has actually been firing pretty much nonstop for the last week and speculate as to what that might mean. We're going to talk about some of the areas showing renewed weakness. Also, as always, trying to identify pockets of this market that are still doing quite well. And the short answer is they're out there. You just have to have the right routines, the right consistent processes of identifying those strong charts. Hopefully, with what we talk about on the show, you're inspired to do some digging on your own. With that in mind, let's get to the market recap today. As always, we're going to have three parts to the show. We'll do a market recap where we talk about what happened through the course of today's trading session. We'll then get to the heat map analysis where we focus on sector and style and individual stock themes. Then we'll go through some charts that I've hand selected through the course of the day to illustrate some key concepts that I think we should be aware of. Getting started here, the S&P 500 big time risk off move again today. This has been the story so far through this week. Weaker jobs data this morning really crushed any sort of optimism that's been out there. The S&P 500 down 1.25%, that is, just below 6,800 for the close. We're getting further and further away from that big round number of 7,000. It's getting distant in the rearview mirror as we continue lower here. The NASDAQ composite down as well, a little bit more, down about 1.6%, and the Dow outperforming, but still down around the same, 1.2%. Mid caps and small caps all in the red. The S&P 400 mid cap index was the best performer, still down about 0.5%. And all those indexes, I think what's most telling, they finished near the lows of the day, right? So if you had optimism, if you had buyers coming in at some point, we would finish more mid-range or maybe in the upper half of today's trading range. Wasn't to happen, right? All these indexes finished near the lows of the day, which I think tells you everything you need to know, right? There's that initial weakness out of the open, and the market just kind of remained weak through the course of the trading day. That weakness in risk assets was enough to push the VIX to close above 20. And we've talked about this over the last couple shows, right? We've traded above 20, or the VIX has drifted above 20 through the trading day. But Tuesday of this week, Wednesday of this week, we traded above it, but then closed back below 20. Today, different story. We actually pushed as high as 23. The VIX accelerated into the close, finishing the day up a full 3 points plus to 21.8. So this is the highest reading in the VIX we've seen in quite some time. I did grab a chart of the VIX to look at in a little more detail when we get to the chart review portion of today's show. But let's keep in mind that one of the big red flags, we talked about this on yesterday's show, right? Two of the things you look for, or at least I look for when conditions are good and you're just looking for signs that that's starting to change. Two things we look for: widening credit spreads, higher volatility. We've highlighted on yesterday's show the widening credit spreads. High yield spreads have started to push higher over the last couple of weeks, and that tells you bond investors are getting nervous. The VIX pushing above 20 tells you the options market is pricing in some anxiety as well. And those two things usually coincide with weaker equity prices, and that's exactly what we saw on today's trading session. Quite a bit of movement in the bond markets. Bonds rallied pretty good. So while stocks finished lower, the relative safe haven of treasury bonds had a pretty good day. The TLT was up 1.1%. Rates generally drifted lower as bond prices went higher. So the 10-year yield down to 4.21%. The long bond yield is below 4.9%. The 5-year point right around 3.75. So we're seeing rates sort of come down. What that usually represents in this sort of environment, as equities go risk off, investors rotating from stocks into bonds, that stock to bond ratio starting to favor bonds here in the month of February. And as a result, rates are coming down. That sort of is usually a bad sign. That tells you investors are a little to a lot less optimistic about economic growth, right? Higher rates here imply that investors are pretty optimistic about economic growth. And so, higher yields or lower yields aren't a big deal. In this case, lower yields are an issue because they tell you that investors are getting concerned. They're going to the safety of the of treasury bonds. and that's pushing rates just to the downside. The dollar, by the way, finished near the highs of the day. Commodities had a rough patch here as well. We can see that gold struggling. It was sort of bouncing around through the course of the day, but finished down at the lows of the day. The GLD down 2.7%. Silver having another big risk off move. And we saw one of these over the last week already with silver plunging to the downside. I think that was on Monday's session, I want to say, or Tuesday. Today, even further, right? Down another 16% on the SLV. So gold and silver rotating lower, along with crude oil, along with copper. You're going to see that energy was not one of the better sectors today, continuing to struggle here. Biggest, ugliest message to share with you, though, is the continued weakness in cryptocurrencies. We talked about how excited we were and how we added some Bitcoin ETFs to our portfolio. And when Bitcoin pushed to 94, 95,000, as it started to give away those gains, as that appeared to be a false breakout, we started to lighten up on our position. We're now completely out of Bitcoin, and good thing, because it's continuing to plunge here this week. Just in the last 12 hours, we've seen Bitcoin down. This is in the last 24 hours. Bitcoin and Ethereum both down over 12%. You can see all of the cryptocurrencies here, the top 10 coins tracked on stock charts, all down double digits. Big risk off move in the cryptocurrency space. Bitcoin currently trading around 64,000. So already, I mean, just in the last month, right? We're down about a third of its value, right? We're down 30+% in Bitcoin, coming off of 95,000 now to 64,000. So big downside rotation. I'm not seeing signs on the chart telling me that's over yet. I'm seeing a confirmed downtrend, which is what we've highlighted recently. Chart like that is guilty until proven innocent. Still guilty, as the charts of Bitcoin and Ethereum would tell you today. Some of the sectors, a lot more of the sectors were in the green, but as the trading day went on, the sector breadth got more and more negative. By the end of the day, utilities was the only sector that finished in the green, and not by much. I'm talking 2 cents, 2 pennies higher than we closed on Wednesday. So the XLU was basically flat for the day. Consumer staples essentially flat for the day. Communication services down about 0.5%. That's as good as it got. On the downside, you can see materials going risk off today, down 2.7%. Consumer discretionary, the XLY, down 2.2%. Technology, down 1.8%. So this was not as much of like a value over growth, because you can see like communication services at the top. It wasn't as much defense over offense, because you can see some of the defensive sectors toward the top, but others not so much. I mean, generally there was a stronger performance from value-oriented sectors than growth-oriented sectors. And I think the big news is technology and consumer discretionary both down about 2% for the day. And those are two big sectors with major weights in the S&P 500. For the first day in a while the market went lower, the breadth was really negative too. And I think as we look at the heat map, you'll see that that's something that differentiates what we observed today versus what we have observed in recent sessions. What we talk about even through yesterday's close was, the major benchmarks pulling back a bit, growth stocks, mega cap growth stocks like Palantir, AMD, Microsoft pulling back as well, but enough value stocks still doing so well, the breadth remaining so strong that even though the benchmarks were down, plenty of stocks were doing pretty well. Today is more of a broader decline, and I think this is the negative scenario. This is the dangerous scenario where you see weakness in mega cap growth, you see strength in other areas of the market. Gives you a little bit of optimism. All of a sudden, if the weakness in large cap growth starts to drag down those other charts, all of a sudden it looks like a broad decline. Then there's nowhere else to go, and you have to start going outside the equity space to look for good opportunities. It's one session here, so let's see what happens through the remainder of the week on Friday into next week. But for today, the NYSE 2-to-1 ratio, stocks down versus up. That's 66% of the index lower. About the same for large caps and mid caps, small caps slightly better, but generally way more stocks moving lower than higher today. Our market trend model, we formally update that every Friday at the close, but barring some big upside reversal on Friday's session, it looks most likely that at least for large caps and NASDAQ 100, we're going to see those short-term models turn negative for the first time, I think, since November of last year. All right, the Magnificent Seven and friends leading growth stocks. You can see Netflix, Broadcom, Meta, all in the green. So friendly reminder, just because most things are down doesn't mean all things are down. Let's, as always, try to focus on areas to be excited about. Now, Netflix is not a great chart, so let's not get too excited about that one. Netflix has been on the struggle bus big time in recent months, down another 0.9%. Broadcom down 0.8%. Meta up 0.2%. The real pain here is in the bottom of the list. We have Microsoft down at 5%, Amazon down another 4.4%, Tesla down 2.2% today. All right, we're going to continue on looking at the heat map. As we do so, I just want to remind you, we're going to be doing an all mailbag episode on Friday of this week. We'd love to include one of your fantastic questions in that episode. You can drop your questions in the comments section on our YouTube channel. We would love to hear from you. Helps us, as always, to get your feedback on the show. Very much appreciate your questions, though. Helps me think about what areas we want to focus on with future content, but also gives us some great questions to address in that mailbag episode. So please take a moment, drop a question in the comment section. While you're down there doing so, feel free to like the video. If you've got a couple hundred friends you want to share this content with as well, so they can start to benefit from our analysis of the markets, I wouldn't mind that either. All right, as we look at the heat map here, pretty mixed day, right? And as I mentioned, the breadth was pretty negative, with most stocks in the S&P going down. But again, it was about a third of the S&P 500, about a third of the NYSE were actually in the positive today. So while most things were down, let's focus on areas using the heat map where the returns were actually positive today. Things that jump out at me, number one would be in the technology sector. While mega cap names Microsoft, Oracle, Palantir, AMD, all breaking down. And the chart of Palantir is going from bad to worse. Confirmed breakdown, classic breakdown scenario below the 200-day moving average for the first time in years, and just continuing to go lower. I mean, at some point, Palantir can be a fantastic chart again, but it is not today. That's a very much a risk-off move, and I'm happy being away from names like that as they are accelerating to the downside. But some of the semiconductor names that have already sold off quite a bit are having a bit of a bounce today. KLAC, Lam Research, ticker LRCX, Applied Materials, AMAT. Those are all stocks that were up today. Again, granted, the trend has been lower over the last week, but interesting to see that they did not participate in the big downdraft. Elsewhere, you can see with charts like Western Digital and Seagate, these are names that are just fresh off of new all-time highs in the last week, but both started to rotate lower, showing some potential short-term weakness. In the financial sector, we can see that while a lot of big banks like JP Morgan, Goldman Sachs were down, I'm noting Berkshire Hathaway, which was actually flat for the day. Something flat for the day while most things were down, something to be excited about. ICE, and not that ICE, this is the Intercontinental Exchange, ticker ICE, bouncing after a pullback. Maybe that's still making a pattern of higher highs and higher lows. I watch moving averages in that sort of scenario. But if you're looking for strength in the financial sector, it's not really in the banks at this particular moment. It's in the more defensive areas of financial, which would be insurance companies. Allstate making a new 52-week high today, up almost 4%. Aflac making a new all-time high today, up 3.4%, or at least a new 52-week high. I don't know if that's a new all-time high for AFL. But there are areas of the financial sector, it's just in the more defensive areas, right? Things like Travelers. These are the insurance names that tend to, be the area of stability within the financial sector. Within healthcare, look at charts like BSX bouncing off of severely low levels. Look at Cigna Group potentially making a new, monthly high. Bristol Myers making a new high, new swing high here. HCA Healthcare very close to making a new breakout. So again, when charts like Palantir just aren't looking good anymore, it's refreshing to know that charts like HCA are out there. This is a stock back above moving averages. The moving averages are now back in the proper order. The price above the 21-day EMA, which is above the 50-day moving average, which is above the 200-day moving average. They're all sloping higher. The momentum is strong, but not excessive. The relative performance is increasing. This is a chart that's looking pretty good. Would be even better if we could make a new high on a closing basis above 520. But for now, I would say innocent until proven guilty. So elsewhere, I would say other areas to focus on: defensive sectors, particularly consumer staples. Consumer staples have been one of the more encouraging rotations that we've observed in the last couple of weeks. We've been highlighting that as 2026 got started, and in January, you start to see some real upside move. I feel like it started with some of the tobacco names like PM, with some of the big box retailers like Walmart. But now we're seeing more and more things like food products, which have not been great charts, starting to improve. Beverages outside of, like things like Coke, breaking out and making new highs, right? There've been like charts like Monster, which have been really good charts for a while. It's the ones that haven't been good that are starting to improve. And that's why the sector is starting to look better. The XLP really outperforming here over the last month. That's it for the heat map. We're going to get to some of the charts that I've hand selected here. Before I do that, I do want to remind you, we have a pretty awesome event coming up this Saturday. My friend Tom Boley called it Super Boley. He actually got that URL reserved for this event, so that's pretty awesome. But I'll be joining Tom Boley of Earnings Beats, Grayson Rose, and Julius DeKempener of Stock Charts, and myself. We will be doing a fantasy stock draft. We'll each be drafting a team of 10 stocks. We're going to be tracking the performance of those names, I believe, over the next 3 months. We'll be reporting on the performance there, crowning a champion. Julius DeKempener, they did one of these at the end of last year. Julius DeKempener, the guy from the Netherlands, beat Tom and Grayson to take the top position. We'll see if I can beat them all. But tune into that event. That's a webcast coming up this Saturday, February 7th at 10 a.m. Eastern, 7 a.m. Pacific. You can sign up using the QR code that you see on your screen, or go to marketmisbehavior.com/Super Bowl. I would love to have you join me at that event. And thanks again to Tom Boley and the team at Earnings Beats for including me. All right, let's look at some charts, shall we? So to get started here, we're going to look at the daily chart of the S&P 500. We've been talking about this sort of stoplight framework to think about the market. And I love things like this that allow you to simplify your approach, a very visual approach, thinking of conditions and where we're at, and helping you think about how you want to be positioned in different scenarios. When the market's in a strong uptrend, I generally want to be owning a lot of stocks, particularly breakout names, and the S&P above 6,900 in that green shaded area would very much be the case. And that's where we were until a couple of days ago when we started to break back down into the neutral area. Today, we closed below the 50-day moving average. We traded below it on Wednesday's session. Today, we closed below it for the first time since mid-January. The last couple closes below the 50-day have been followed immediately by a close back above. And if that doesn't happen tomorrow, I would say this is confirming some short-term weakness in the major equity averages. Now, I would consider this chart to still be fairly neutral, particularly on that medium-term time frame, until and unless we break below 65.50. That would take us from this neutral yellow shaded area to the bearish red shaded area. That would bring us down to the 200-day moving average. Maybe we close below that. And if those are the things that happen, we make a new 3-month low on the S&P, I think that's a big time risk-off move. And personally, I'd be getting very defensive in my own portfolios. And I would encourage you to think about those potential levels of risk and what they might mean. We've been talking about the skepticism that is pretty clear in January and February as the market's trying to make new highs above 7,000, but the momentum is very much in a neutral range. So the momentum has not been confirming a bullish phase since October, and that's been a big red flag for this market over the last couple months. By the way, I just put a video out earlier this morning, a choose your own adventure style video, the S&P 500 with 4 different scenarios laid out. You can find them on my YouTube channel. Please make sure you watch that one. Good way to shake free your preconceived biases, to get out of your own way and open your mind to some different scenarios. You watch the video and then you vote on which scenario you think is most likely and why. Then you get to see what other people are voting as well. And that can be a really helpful therapeutic process as you're trying to make sense of these markets. The Hindenburg Omen has fired a number of times, and I want to thank my friend Dan Bird, who shared a number of charts. He's a fantastic technical analyst based in the Southeast, and has very kindly shared some random charts with me, and I've enjoyed having a dialogue with him now for a while. And he actually is way better at using stock charts than I am. I will tell you that right now. And his website's Breakpoint Trading, I want to say. I'm sorry, Dan, that I don't remember that right. I'm pretty sure it's Breakpoint Trading. But if you look for Dan Bird, you'll find that. He has a great way of visualizing the Hindenburg Omen. He does it like a histogram. So I'm just kind of doing this to show the cluster of signals, right? This is just in the last week. We've had like 4 different days where the signal was triggered. And again, that is triggered when the NYSE is up over the last 50 days, which it has been. when at least 2.5% of the NYSE listings make a new 52-week high, and at least the same amount make a new 52-week low on the same day. And that's happened a bunch of times in the last week. And then the McClellan oscillator goes below zero, which tells you the breadth in the short term is turning negative. And that's been the case for the last 4 sessions. Today did not qualify because the McClellan oscillator is back positive. Actually, I think that was yesterday, Wednesday, that the McClellan oscillator went slightly above. I'm assuming today the McClellan oscillator most likely goes back below zero. So that cluster of signals, it sort of reminds us that the Hindenburg Omen fired a bunch of times in October and November. That told us to start preparing for a major top. Maybe this is the beginning of that. Maybe we get another cluster of signals, sort of a renewed sell signal from the Hindenburg Omen. We'll keep an eye on that. I don't have a hard rule as to what this means, that you have a couple months break and then you have another firing of that indicator. But I may spend some time looking back through market history and see if there's some parallels I can compare that to. Then the breadth, as I mentioned, getting worse today. The breadth in the NASDAQ 100 has been getting steadily worse here over the last 6 to 8 weeks, really. And if you look, the bullish percent index on the NASDAQ 100 is down around 37%. That's a breadth indicator based on point and figure charts. When this indicator gets down to 30%, particularly when it goes below it and then breaks back above it, that has ended up being one of the better buy signals I've seen on the tactical time frame in terms of breadth conditions. The McClellan oscillator is another one of those breadth indicators that's good for short-term reversals that I like to use. We're very close to getting to that point where I think the NASDAQ 100 could be setting up for a good counter trend bounce, but we are not there yet. So we can keep an eye on this chart for now. The breadth is just getting worse, which tells you, even though the larger, breadth indicators like the advanced decline lines have been very strong, the NASDAQ 100's bullish percent index has been declining steadily. That says risk off in large cap growth. The VIX finally closing above 20. I just want to remind you, going above 20 is usually not a good thing. The last 2 times the VIX has pushed above 20 was October of last year, where we had a brief pullback to around 65.50. That was that first time we tested that really as support. In November of last year, we broke above and closed above the 20 level. The S&P had already started to pull back, ended up coming down a little bit further to retest that 65.50 level. Now that we're closing above 20 again, really feels, along with widening credit spreads, the market is in a risk-off position. The longer that the VIX remains above 20, the less good that chart looks for the major equity averages. Got some sentiment data to share with you here today. The AAII survey came out today, down to 39, we'll call it 40% bulls. That's down from around 45% last week. The bears down slightly to 29%, so still about an 11% difference with bulls over bears. That's kind of steady bullish range, nothing really noisy or severe there. The name exposure index came in quite a bit last week. It was around 92, 93%. Last week, this week, it's down around 85%. So a bit of a risk-off move there for the name exposure index. That's still above the long-term average, right? Long-term average around 75, 80%, if I remember right. But keep in mind, this is an indicator that's been trending downwards over the last 2 months, basically implying that money managers in that survey, in that sentiment survey, have been going more risk-off over the last 2 months. All right, finishing off here, we'll talk about Bitcoin. Bitcoin on the weekly chart closing below its 150-week moving average for the first time since fourth quarter of 2023. I'll say it again, Bitcoin's come down so much, it actually closed today below the 150-week moving average. And if we finish below that 150-week moving average through tomorrow's close on Friday, that'll be the first weekly close below the 150-week moving average since October of 2023. That's how long Bitcoin has been in a primary uptrend. That's how far it's come from an all-time high around 125,000 in October of 2025. So that's what, 4 or 5 months ago, and we're at 125. We're half of the value that we were there about. That's how far Bitcoin has come down. Now, the reality is, if you look at the history of Bitcoin, this is quite common. It is fairly uncommon for stocks, for the S&P to lose 50% of its value, although it has happened more often than you probably want. but not very regularly. Bitcoin, with a lot more volatility, has way more times in history where it's lost 50+% of its value. I'm looking at the weekly chart, taking the 2022 low and the 2025 high. I'm noting that that first bounce in November was right at the 38.2% retracement of that long-term bull market phase. That's pretty interesting. The 61.8% level is around 58,000. That actually lines up with the lows in summer of 2024. That's our downside target for Bitcoin, sort of in that 50 to 60,000 range. We're very, very close to it. So as we are oversold on the weekly chart, getting to that key level, is that a level where we might anticipate a potential low? It is. What would really convince us that we're starting to see a broader reversal? This is where the weekly MACD or the weekly PPO can be very helpful. The other thing I'll be looking at is a trend line connecting the major highs over the last 6 months. Take the October, November high from last year, take the January peak around 95,000. That gives you a pretty good pace of this decline until and unless we can get above that trend line. I'm probably happy avoiding Bitcoin for now. One of the ratios that I like to look at is the high beta versus low volatility ratio, which you're seeing here. The last time this really rotated on the side of low volatility was back in November, the last major pullback that the S&P experienced. Here we once again go below the 50-day moving average, and if that would continue lower, that'll be another very negative sign to go along with some of the other things we've shared. Ratios, things like offense versus defense, right? Consumer discretionary versus consumer staples, kind of a similar idea. Here we're looking at higher beta, kind of higher risk, more volatile names versus more defensive, low volatility names. This is looking at, stuff like technology and industrials and financials versus low volatility utilities, real estate, consumer staples. This basically is another sign that investors are rotating to more defensive positioning. I want to refresh the chart of AMD here. It did make a new 3-month low today on a closing basis. We talked about that $200 level was violated just briefly on an intraday basis. Yesterday, the question on yesterday's show, does that hold? The answer is it did not. We actually closed below there, which says risk off for AMD. Alphabet, which had a lower open after a pretty decent earnings release, did trade higher through the course of the day and did close back toward the highs of the day. So did trade below its 50-day moving average, but did not hold it. So overall, Alphabet remaining, I would argue, by far the strongest chart in the Magnificent Seven. Pretty good, big time bearish momentum divergence, though. And so we'll see if we can regain the 50-day, which we did today, and hold it. Now, 2 charts ago, I showed AMD breaking down through support. Eli Lilly, and thanks again to Dan Bird, by the way, for sharing this chart with me earlier today, had a nice bounce on earnings. So you had AMD gapping lower. You had Eli Lilly doing the opposite, gapping higher. This is a pharmaceutical name, of course, in the healthcare sector, testing the upper end of this range. But today, giving all of those gains back, we're back down toward the lower end of this range. If charts like Eli Lilly having good earnings that initially break out, if no buyers come in, it's not a good sign. Final chart for the show, famous quote by Alan Shaw, legendary technical analyst. When the going gets tough, the tough get eating, smoking, and drinking. Here are 3 charts that tell the story of what Alan Shaw was getting at. In terms of eating, here's Hershey Foods Group making a new 52-week high today. Smoking, here's Philip Morris International making a new 52-week high today. Drinking, here's Coca-Cola making a new 52-week high today. So that quote was a way of recognizing that when market conditions get really tough, investors tend to rotate to more defensive sectors, particularly consumer staples like food products, like tobacco names like Philip Morris, beverage names, alcohol, soda beverages, all these different sorts of things. Coca-Cola representing that space as well. So that dangerous defensive sort of theme that Alan Shaw famously put to that awesome quote and love to share seems to be materializing here in early February of 2026. Risk-off conditions getting more and more prevalent. We're going to continue to monitor these through the weekend and into next week. So please keep tuning in. Please take a moment, if you could, and drop a question in the comment section of our YouTube channel. We'd love to feature one of your questions on Friday's episode, which will be an all mailbag episode. That's it for tonight. From Boston, Massachusetts, I'm Dave Keller, reminding you, as always, it's always a good time to own good charts. Have a good night, folks.